Yes, Nvidia stock could fall 90% from here, and it's relatively simple to show exactly how that would happen. Basically, all of the tailwinds that have been behind the company over the past decade could reverse over the next few years. The revenue growth, the margin expansion, the multiple expansion, all of it may be fleeting if the course of artificial intelligence has changed just over the past week. I'm going to run through a model and show exactly how the stock could fall 90%. And remember, it was June 19th, 2024 that I said Nvidia stock could fall 50%. What has the stock done since then? This is a chart. Shares are down 8% over that period of time, and everything has gone Nvidia's way. May not be the case in the future. The big thing for investors is price matters for the companies that we are buying or potentially selling. So let's show exactly how I get to this 90% drop in the stock that you see here. What I'm going to be using to show this is all the information from FinChat. I'm excited to have them for the sponsor of this video because FinChat is what I use for all of the images that you see here on asymmetric investing. When you see something like a stack chart of revenue by segment for Nvidia, this is coming from FinChat. The multiple expansion. You may have heard me talk about this before, but the price to sales multiple alone has beaten the market at a compound annual growth rate of 29% over the past decade. All this information, very, very easy to find on FinChat. They've got financial data for 100,000 companies globally. And the best part is with my link below and the link that's on the screen, you can try FinChat Pro for free for 2 weeks. If you decide to upgrade, you can get a 15% discount. I am a paying user of FinChat, so my money is where my mouth is with this one. But let's dig into a feature that not a lot of people know about, and that is modeling. I'm gonna actually reset this data. But what they've done here is they put some analyst information, and that's in the estimated side for Nvidia's valuation. They also have the actual data from the numbers that have been reported. So 2022, 2023, 2024, this is all actual information that will help us model Nvidia's price based on things like revenue growth, EBIT margin. You can change the weighted average cost of capital, the terminal growth rate, things like that. I'm just going to change a few very, very simple things just so we sort of level set expectations here. When you reset this, you actually do see that Nvidia potentially has some downside. This is actually based on the close on Friday, so $142 per share, but it's saying that this model says that shares should be valued at $83.50 per share. I'm going to change just a few assumptions that go into this and show how the stock could potentially fall 90%. Because I think the changes that we've seen in the artificial intelligence landscape over just the past week or so tells us that there's going to be some potential headwinds. What are those headwinds? Well, big data centers may not need as many NVIDIA chips for training. So we have growth in these reasoning models like O3, like O1 from OpenAI. And then you have these much more efficient models like the DeepSeek model that has gotten a lot of attention just over the past couple of days. So is that possible that that hurts the growth rate of revenue? Well, let's just take this to zero. Okay, and I'm leaving 2025, fiscal 2025, where it is because that's obviously not going to change based on the information we have today. But let's just assume that this growth rate goes to zero. Now, is that something that's reasonable to assume? Well, if you look back historically at NVIDIA, sure, it's very reasonable. There are periods of time where NVIDIA actually goes negative on their revenue. Now, of course, a lot has changed as artificial intelligence has become more common, as the data center business has grown. But remember, the data center is driven by really just a handful of companies. So if they decide to, instead of spend $80 billion on CapEx next year, like Microsoft is going to do, maybe the next year they decide to spend $50 billion. Well, that means that revenue could potentially fall. At least that revenue growth rate may not go up at 100% like it has recently. We have also seen that the rate of growth is coming down. So you have a 200% growth rate through January 2024. Now we're at closer to a little bit under 100%. Analysts are expecting growth for 2026, but this is not nearly the same growth rate, expecting that growth rate to come down pretty significantly both next year and then into 2027. So what this model should give you an idea of is how much growth are you really paying for? The other thing is margins. One of the major tailwinds that NVIDIA has had the last few years is margins going from what they have historically been for the company to extremely high margins. You can see the estimate is a 66% EBIT margin for this current year, the next current fiscal year that they will report. All right, we can look up EBITDA margin here on FinChat. Historically, you can see as low as 20%, up to 35%, dips down again below 20%. So let's just say that we have a long-term margin of 30%. I think that's pretty reasonable. If prices start to come down, you're going to get much more competition as there's going to be more inference uses for artificial intelligence, not just training. You don't need these massive clusters. So that's going to bring in much more competitors, whether it's homegrown chips from companies like Amazon or whether it's chips from AMD. I think competition comes in, margins start to come down. So we're going to take this EBIT margin to 30%. I think that's probably a safe historical number, maybe higher, maybe lower. But again, we're looking at how does a stock fall a dramatic amount for Nvidia. So this gets us to a point where just those two changes, just a change in the growth rate and the margin, means the stock has a potential downside of 87%. The other thing that I want to change is the exit multiple enterprise value to free cash flow. This is currently set at almost 33. What does this look like historically for Nvidia? Well, it's all over the place. Sometimes it's 60, you can go down to 30 here. But if you go back to 2015, 2016, 10, 11, 8, if we're modeling the long-term valuation of Nvidia, to say even 30 is going to be extremely high. So let's knock this down to 20. I think that's still above average enterprise value to free cash flow. But I think that's pretty reasonable given the potential headwinds for Nvidia's business. So just changing the growth rate, remember Nvidia is still going to be a $129 billion company based on these numbers, changing their margin because more competitive products come into the market, you have a little bit less demand because inference moves on device, moves to more custom silicon. And then you just change this exit multiple from the model itself. So this is basically once you exit 2031, now that exit multiple is just 20 times free cash flow. You do all those things and you get downside potential for Nvidia stock of 90.5%. I think the takeaway here is that investors are looking at a chart like this and assuming that this growth chart, the margin expansion, the multiple expansion, and the revenue growth rate are going to continue in perpetuity for Nvidia. That is what is already priced into the stock. And so if you just go through the mental model of what happens if something changes, what happens if the growth rate goes from 100% to 0%, what happens if margins go from 60% to 30%, what happens if you don't have a long-term enterprise value to EBITDA multiple of 60, now it's just 20. That's still a very high enterprise value to free cash flow multiple. You can find stocks that are trading for lower multiples than that very easily on the market today, but Nvidia is not one of them. So a lot of growth is already priced into Nvidia stock. That's why news like what's coming out from DeepSeek, changes in pre-training for artificial intelligence, competition coming from other chip companies and competitors, all of this is something that investors really need to think about. And is it worth paying the price that we're currently paying for Nvidia stock? Even after shares dropped 16% on Monday, I still think there's massive, massive downside for Nvidia if any of these risks do materialize, and this is not a rocket growth company in the future. So 90% downside may seem extreme, but even just a few changes to Nvidia's business and a few headwinds means that valuation could come down really significantly. So whether you're an Nvidia bull or an Nvidia bear, I think it's always worth going through this mental model. What is actually priced into a stock? Where is their upside? If you want asymmetric potential with investments, you need to look at what is not priced in. Where are there growth opportunities where I don't actually have to pay for them? That's one of the things I'd like to say here on asymmetric investing is buy growth you don't have to pay for. And with Nvidia, you are paying for a lot of growth. So that presents a lot of risk for investors. Worked out very well as those multiples were expanding. But if we see multiples compress, if we see margins compress and revenue growth come down, that could mean disaster for Nvidia stock. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.